you'll see that I'm really excited about this topic. It is a monograph, and it's a lot of concepts, and I know the whole theme of this conference is disruption, and actually I plan to follow that theme in my talk today, because I think we're going to, perhaps more on a theoretical level, but disrupting the way we think about investments and how we price assets. So, and how, of course, we involve both behavioral finance and classical finance and put them together. You can see the title, Popularity, a Bridge Between Classical and Behavioral Finance. So I, of course, had, I'll give a little bit of an introduction. I'm chairman of Zebra Capital, but I'm also been a long-term, I've been a professor at the University of Chicago, and now the last 30 years really at Yale School of Management, where I'm emeritus, and of course I founded Ibbotson Associates way back in the, I don't want to give the dates because you might figure out how old I am, but I founded it quite a ways back, but I sold it to Morningstar, and it's still part of Morningstar. Back in 2006, I sold the company. So anyway, I'll remind you that the online version of the monograph is available through the ICFA site and through the conference site and so forth, and available for free. And, but we're also making the monograph itself, the paperback, available. So, and I want to say I've got 3 co-authors here. These co-authors are from Morningstar. They are Tom Adzorek, Paul Kaplan, and James Shong. They're all from Morningstar. So let me proceed here. So we'll start out with the capital asset pricing model. This is the, of course, this model was originally developed by Sharpe and Lintner and Traynor and so forth, Mawson even. So lots of people involved. Bill Sharpe won the Nobel Prize, and of course he deserved it. This was really a great contribution. And it's a nice, simple model, and we had some great theory behind it. The expected return is the riskless rate plus the beta, whatever the beta asset is, times a market risk premium. So what's so great about this is it's so practical. It's only got 3 inputs, and the risk-free rate is a rate that you can just look up, I guess, although we could debate about what horizon you should be using. So it should be perhaps use a shorter horizon or a long horizon, depending on the context. And the market risk premium is only one number. And there's lots of debate on what that number should be. Of course, it's a forward-looking number, a future number, but it's only one number that applies to all the assets that we're talking about. And then we only need, each asset has a beta. And you multiply those together and you get the expected return. So this is really a wonderful contribution. And but I'm going to show you that we can go beyond that, really, because the key assumptions here are risk aversion, only one kind of risk, and homogeneous expectations. And if you open this up to those two, loosen up those assumptions, you actually can get something really realistic. We want to include all kinds of preferences, not just the one kind of risk preference, other kinds of risk preferences, non-preferences that have nothing to do with risk, and in fact, of course, might even be related to behavioral finance. So we're opening it up to everything, and we don't have to have all the same opinions about what's going on. So here's the outline. What is popularity? The nice thing about what we're talking about here is it's going to be something very simple. Of course, you already kind of know what popularity is, but we'll talk specifically about it. We're going to then go on and talk about classical finance and what that means. It's essentially the risk and return relationships, and then adding more dimensions, but staying in the classical framework. And then we're going to introduce the popularity asset pricing model, PAPM, and this will generalize the CAPM, and we'll show in the context that it'll be an equilibrium concept that we'll look at here. We'll go into behavioral finance. We'll look at a couple of examples and some little bit of empirical work to show that how this could be used. And finally, we'll bridge everything together with the conclusions. So that's where we're going here. And I guess I have big aspirations for this because I think it can actually simplify our thinking and make everything more intuitive to us and how we think about investments. So what is popularity? It's, of course, what you think it is. It's anything that you like, prefer, recognize. And in our context here, it's really how much you demand. And really excess demand. If you demand something more than just for their cash flows, but for something beyond that, that definitely is popularity. Or there'll be also things we like and we don't like. And so assets that are popular, they may be unpopular. The key is, though, here, popular assets, very intuitively, are going to have higher valuations. But given the same set of cash flows, popular assets are going to have higher valuations. They're going to have lower expected returns. And the kinds of assets that we don't like, that are unpopular, their value is going to go lower, and that will give them a higher expected return. So what we're going to have then is a concept that can explain really all the things you talk about, the premiums in the industry, the anomalies, and even the mispricing, all of these. And we'll talk about whether these kind of things can be arbitraged or not, and how you could have all different sorts of opinions about this. So that's what popularity is about, and I'm arguing that it's one simple concept that can put everything together here, bridge the whole investment industry. So let's start with classical finance. What is classical finance? It starts out the major assumption of classical finance is rationality. Classical finance assumes we're all rational, so we're trying to maximize the cash flows and expected returns relative to things that we care about, rationally care about, like risk, liquidity, tax efficiency, so forth. Those are the things that we're trying to do here. We usually do classical finance in one of two frameworks: arbitrage or equilibrium. And arbitrage is the law of one price. It ties two assets together. They're priced relative to each other. Equilibrium is where supply equals demand. I'm going to argue here, though, in our, say, the stock market and most of our asset markets, that in order to price assets, it's the equilibrium model that matters. We can't, in the bond market, we can often use arbitrage. We can arbitrage forward rates against each other in different ways, or in option markets, we can arbitrage between puts and calls and the underlying stock and so forth. But in, say, equity markets and a lot of the other asset markets, we can't really arbitrage. There's nothing clear to arbitrage, and I'll give you examples of that. So we're going to be in an equilibrium framework, but I will specifically address how easy it is to arbitrage any of the kind of assets we're talking about. And then the other principle of classical finance is efficient markets, that security prices reflect all available information regarding their value. The prices are fair. These are the principles. Now, they won't all hold up always, especially when we go into behavioral finance. Now, so here's and I've done this as a scale. I could have put equations up here, and some of you want the equations. And the equations are you can find them in the monograph that we're talking about here. But I'm mostly not going to use the equations in this talk. I know there's a call for equations in the audience, and I empathize with you, but I'm not putting them in here. I'm using a simple balance beam here. So in the capital asset pricing model, there's that one kind of risk, And the more risk there is, the lower the valuation. But given the same cash flows, the higher the expected return. We have that simple relationship between risk lowers the valuation, but higher the expected return. The capital asset pricing model does it. Even if you have multiple risks in there, all those risks essentially are lowering the valuation, but raising the expected return. So that's our kind of our starting point. And I was just talking to Ron, who's going to speak later after me today, about stocks, bonds, bills, and inflation. I came out with the data back in, the original version was back in the 70s when I did this, because people were asking about all the risk premiums that were in the financial literature and what were their measures. And the whole purpose of me putting all these data sets together, which I originally did back in the 1970s, was to measure risk premiums. And one of the things that came out was this chart where you start with $1 in 1926, and now taking it to 2018, that's 93 years. And with 93 years, taking that dark blue line here, that's large cap stocks. Well, large cap stocks have had a 10% return per year, annualized return. That means you're going to actually double your money roughly a little over every 7 years. And that doesn't seem like a lot, but over time, it really exponentially grows, so that $1 growing at 10% for 93 years actually grows to $7,000. So you can see how you can potentially get rich by just hanging in there. Now, this is without any fees or transaction costs or taxes or anything like that. So that's sort of a gross number, but still it's an amazing number. One of the things we could do to correct it, at least for inflation, I've got inflation in here, inflation grew 14 times over that period. So you can actually divide that number, 7,000, by 14. It works out almost like a round number today. It's about just over 500 times your money. So even inflation adjusted over the 93 years, $1 grew to over 500 times your money. And that didn't happen so much in the other markets, like the green line there, the lower green line, that's Treasury bills. If you divide that 21 by 14, in real terms, Treasury bills only grew 50% in the 93 years. So big difference. You didn't get that kind of return by staying in a cash-like instrument. And also you, in bonds, those are long-term bonds, you divide that number by 14, you get about 10 times. So you only grew about 10 times over 93 years in the bond market, 1.5 times in the bill market, but 500 times in the equity market. It definitely shows you that there's a risk-return relationship, as we would expect in the capital asset pricing model. People want to be paid to take risk. We like the return of stocks, I guess. Well, we don't like the risk of stocks, and the only way you get us to buy those stocks relative to cash or bonds is to actually give us an extra expected return. And we have achieved it, you can see. All right, so this is essentially saying that risk works. This is, I'm now showing you the data from Dimson, Marsh, and Stanton put together here in Britain, and across 19 different countries over the, starting in 1901, so now we're looking at 117 years. And the lower blue numbers there are the Treasury bills in those countries. Those green boxes in the middle are the bonds of those countries, and then the top triangles there are the equity markets. So you definitely see that stocks beat bonds, and bonds beat bills in all these different countries. But you also see something kind of strange there. You see that across these stock markets, so it turns out that the lower risk markets actually had higher returns than the higher risk markets. You see that across the bond markets, the lower risk had higher returns than the higher risk markets. And you see the same thing in the bill market. So you see now something very strange, at least strange in the context of the capital asset pricing model, that there are things going on here that are counter to the capital asset pricing model, or at least additional to the capital asset pricing model. And we're trying to learn about that here. And here's a little study we did. This is not published yet, but this was 20 years, and actually I have a longer study going back to 1972 and getting a similar result, where we just broke the US market into quartiles, where we rank a bunch of type of phenomena, like beta of a stock. We rank it into quartiles, and these are color-coded. There's actually 21 different metrics here. There's a couple of different value metrics and a couple of volatility metrics and couple of liquidity metrics and so forth. They're color-coded. I'm not saying you could follow all the colors, because you're not supposed to do that here. It's kind of hard to see all that. But what you will see, the line rising from the risk-free rate to the market portfolio in the middle of that clump, that's the capital asset pricing model line. And then we have the data of all these, where we rank all the quartiles from all these different criteria, actually 21 different metrics with quartiles, so there's 84 different portfolios here. And we look at the returns, and we look at the risk, and we plot them, and we run a regression line. And clearly, I could have put the t-statistics in, but you can see this with the naked eye, of course. It's not even hard to see, even if you close one eye or whatever, that we have this relationship that is not the capital asset pricing model relationship, but actually it turns out that within the markets here, the lower risk assets have higher returns than the higher risk assets. Now we'll look at different markets. Repeating the same thing with the U.S. market on that side, and then the UK market on the other side, and the Japanese market in the middle there. But all three of them do not in any way represent the capital asset pricing model risk-return relationship, which is in dark blue, drawing that simple line between the riskless rate and the market portfolio. In fact, UK and US and most other markets that I've looked at have this negative relationship. So what do we do here? Think of this from a theoretical perspective here, because it helps. We want to be theorists, and I'm bringing you don't all want to be theorists, but if you think of it, helps you conceptualize what's really going on, and so that you can think about how to actually do investments. If you have to do something to this, what's missing? The capital asset pricing model isn't wrong. It's actually, certainly it's true that we don't like risk. That's one of the things that's unpopular. It's just that it's not including everything here. What's missing, we still need a universal concept like the capital asset pricing model, something that affects pricing. But we need to include other preferences here. And that's what we're going to do. We'll include a lot of other preferences in doing this. So staying with my balance beam here, the classical rational, this is nothing irrational here, but we'll put in all the kinds of things that we care about. Risk is something we don't like. We also don't like less liquidity. We don't like kind of assets that might be more taxable. These are classical concepts. Some assets are taxed differently than other assets, and those we like the more tax efficient assets, not the less tax efficient assets. So anything that we don't like is going to lower the valuation, but given the set of cash flows, it's going to raise the expected return. So you can see this is really a PAPM and CAPM are demand models. We're basically setting supply fixed here. Corporations are supplying expected cash flows in some securitized form. And, but investors are demanding, have preferences for these, and particularly the form that they come in. And so prices are going to equate the supply and demand, but when they come in a certain way, like a risky or illiquid way or something, we're not going to like that, but we'll still buy it if we get a high enough expected return to offset that. So we're just including more things here. Now, I'm going to actually bring you to the PAPM, the Popularity Asset Pricing Model, which I think actually should contend to how you really look at the world with the models that you might be familiar with, other models. So it builds on the CAPM, which I think is an advantage because we're all familiar with the capital asset pricing model. And it builds on this equilibrium framework. It aggregates demand across now additional risk, and they don't have to be risk, they can be non-risk characteristics. Like I know some liquidity models, for example, think of that as liquidity risk, but I don't think of liquidity as a risk. I just think of liquidity as something, extra trading costs and things like that. It's something I like, I guess. We all like it. And so it's something we like, but it isn't necessarily risk. We're including non-risk preferences as well. And they can be rational or irrational. Now, I've got a big picture of some aspirin there. I'm hoping not like you need it right now after this talk so far. I mean, but the idea here is that you can buy, Bayer's actually was the original introducer of aspirin, and the inventors were connected with Bayer in different ways. And then there's a generic aspirin. Now, aspirin, though, is certainly a drug that has generics. The formula is well known and it's not under any patents anymore for a long time. And these two boxes here have the identical amounts of the aspirin in them. They have the identical doses and the identical chemical makeup. The only thing different is the way those boxes look, the packaging. But you can see there's a price differential there. There's a big difference in how they're priced. And I guess, can you arbitrage that? Well, it's pretty difficult to arbitrage that particular distortion that you might see in the market there. And I'm going to argue a lot of other situations in equity markets and so forth are going to be difficult to arbitrage. So just because you find these distortions, in this case there's two things that are identical, you can't even easily arbitrage. So I'm going to argue that it's not easy to arbitrage it away, that our preferences can stay in the prices. And that's what I'm going to show you next. And by the way, one important point of this is, despite this differences in prices, Bayer still sells a lot of aspirin. There's still a lot of people will buy the Bayer aspirin. They might see them next to each other on the shelf, but they're going to still buy Bayer aspirin. It's not there's some preference for that Bayer aspirin. People like the brand and so forth. All right, so here is an illustration, and I hope you can all see it if it's big enough on the screen. It's essentially, we're going to do an illustration with 5 securities and 3 investors. And the 5 securities are going to have some popularity characteristic with us. But they're going to, besides having a beta and so forth, and there's a correlation matrix there, and an expected value. The expected values are different just because these companies are different scale. Security A is the bigger company, and Security E is the smaller company. But the important point for us here is that Security A is the popular security. Some people like Security A. And Security E is the unpopular security. So, and then B is relatively popular, and D is relatively unpopular, and C is sort of neutral. So they're ranked in popularity. And now we have these 3 investors. I'm going to give them names just to make it simpler, get you tie it in. Think of the investor 1 as the institutional investor. They have a popularity preference, but it's not as strong as the retail popularity preference, which is investor 2. And then I'm going to just call these hedge funds. I'm not going to say hedge funds really do better at this, but we're going to say, let's have a class of investors that don't have any popularity preferences. They are our potential arbitrageurs. So they're going to try to arbitrage this. They don't care about this popularity at all, whatever it is. You know, they don't care about it. They're going to take advantage of it. And so now we're going to look at what happens. Well, first of all, in the CAPM column, I've got their expected returns. It just comes from their beta. So you can see that the top one, the popular security, has a 623 expected return because it has a pretty low beta. The low popular security has an 828 expected return because it's just from its beta. But now we take into account that the security A is popular. That means, of course, the price went up, the price goes up for it, and the expected return goes down. So you now see that in the PAPM framework here, and I did put equations in there, in the PAPM framework, security A actually has a much lower expected return, lower than the CAPM would say. And security E, because it's unpopular, has a higher expected return. So we'll show you how the equilibrium works graphically in a second here, but just the main point is that popularity stays in the price despite our arbitrager, and we'll show you how that arbitrager tries to remove it. So here's the graphical comparison between the capital asset pricing model and the PAPM, the popularity asset pricing model. You're familiar with the capital asset pricing model. That orange button in the middle there with a black circle around it, that is the efficient portfolio. It's also the market portfolio. So in the capital asset pricing model, the efficient portfolio and the market portfolio are the same portfolio, and then that line goes through the riskless rate. Now, the great simplification of the capital asset pricing model is everybody holds that they all have the same opinion about everything, and they don't have any special preferences of anything other than risk. So everything collapses down, and this is a great contribution of the CAPM, that everything collapses down to the point where the efficient portfolio and the market portfolio are the same thing. So we all hold that, and if you're relatively risk averse, like investors 1 and 2, you're going to mix in some cash with it. You'll have some cash with the market portfolio. But if you're like investor 3, who's willing to take more risk, you're going to lever, you're going to borrow, but you're still going to hold the market portfolio and negative cash. So everybody holds the same portfolio, and those 5 securities get in there with their market weights. And yes, but now we're going to go to the PAPM. We have the nobody's going to hold that market portfolio actually. And notice first security A, which is red there, it's the most popular. Its return has dropped because it's so popular, its return has gone down. And security E, which is so unpopular, its return has gone up. And to a lesser effect, B and D moved as well. So these securities have all changed their expected returns based on their popularity. And now the market portfolio is no longer efficient because, well, first of all, nobody holds the market portfolio. We all hold unique portfolios according to our preferences, and that market portfolio is not an efficient portfolio. There is an efficient portfolio, which I've got there in orange. And investor 3, who doesn't have any preferences for popularity at all, will actually go after that efficient portfolio. But the others will go after some portfolio that has these popular characteristics, like it may be very liquid, besides being its risk characteristics. And ultimately, so now we all hold different portfolios. And and the market portfolio is not efficient, and nobody holds it. So now we get to the holdings of all these portfolio managers, or these are really, you can think of them as clienteles, groups of investors. Investors 1 and 2 are going to load up on security A because it's so popular. They like, maybe it's very liquid or it has a good brand or something like that. They load up on it. And they avoid as much as possible, or almost totally avoid security E, which is so unpopular. Meanwhile, that arbitrager effectively takes a negative position, a short position in security A, and really buys almost all of security E, and levers it up with a big negative cash position. So investor 3 is being very aggressive in trying to go after this, and investor 3 certainly does benefit because he or she gets great returns, better returns actually, by putting that kind of portfolio together. So investor 3's expected return is much higher than anybody else's, but the key point from our perspective is they're not removing the arbitrage here. There's no real arbitrage taking place. All of the people in the market's preferences are being aggregated together. Everybody's impacting this and nobody removes it. And why can't the arbitrager get rid of it? It's because the arbitrager, we don't have to have anything artificial here, the arbitrager is risk averse. Ultimately, the arbitrager needs a diversified portfolio. You may find bargains in the market, but can't really fully take them here. Has to actually, being risk averse actually, limits the arbitrage. So now if we compare the capital asset pricing model to the popularity asset pricing model, the CAPM to the PAPM, what have we done here? Well, it starts out with the key assumptions here. Remember, the key assumptions of the capital asset pricing model were really 2 key assumptions that we had: risk aversion, and we had homogeneous expectations. We all had the same opinions about everything. We could have different risk aversion, but that only led us to different going up and down the market line. Meanwhile, we go to the PAPM. We have risk aversion, which is certainly key. It keeps us limit how far we're going to go, but we have other preferences, and we have other opinions as well. So we don't have to have all the same opinions. And when you look at our preferences under the capital asset pricing model, we just want to maximize expected return for a given amount of risk. That's what we want in the capital asset pricing model. In the PAPM, we want to maximize the expected return relative to numerous preferences. Whatever preferences people have can go into this. So the whole set of preferences can get priced. And so now, does everybody hold the market portfolio? Well, in the CAPM, yes. And actually, that's a good feature of it because it makes everything so simple. And now it gave us the whole beta theory and so forth, how we could have a beta describe a lot of things. So everybody holds, but it's all based on everybody holding the same market portfolio. But in the PAPM, we all have different preferences. We're unique. We need customized portfolios that match our own particular preferences. So how are the securities priced then? Well, in the CAPM, they're just priced according to that one beta. But in the PAPM, there are going to be multiple premiums in the market. And they won't all be related to risk either. There are going to be all kinds of, whatever we like and don't like is going to get priced. It's not going to get arbitraged away either. It may be partially arbitraged away, but generally we're going to aggregate across all of us. And no small group of arbitragers can remove this. So what's the great advantage of these 2 models now? Well, obviously you're familiar with the CAPM, and it's done so much for you over the years. It's simple. It's got 3 inputs: a risk-free rate, the market premium, and the betas of stocks. And the betas of stocks are kind of easy to estimate too. We've got a long literature on how to estimate that. And so lots of debate about what those inputs are, but still, there's only 3 of them. In the PAPM, there are many things, anything that we really care about, anything that is popular or unpopular, is actually going to affect prices because we're aggregating their demand. So the PAPM is really the CAPM in a generalized form, loosening up those assumptions, and we can also allow for different opinions, actually. We don't even need the homogeneous expectations anymore. And so now we can actually move to behavioral finance. So when we move to behavioral finance, now we can contrast the classical finance. We don't need rationality to have PAPM. We don't really care what you like or how you like it. But if you like something in some systematic way in aggregate, whether you're rational or irrational, it's going to get impacted into the prices. I mean, it's possible that there are people who like something and don't like something, and they'll balance off in some way. So some things won't matter, but some things will matter. And it goes beyond the simple risk. So, and we can have biases. We can now have behavioral biases in the market, which could impact that pricing. So lots of the distortions in behavioral finance are like loss aversion, overconfidence, framing, anchoring, and so forth. And like I often ask, you probably have all talked, I should do it here in this room. I often ask my class a simple question. I have them raise their hands, and I guess I'll do it here. How many of you think you're a better than average driver of an automobile? And how many of you think you're a worse than average driver? Well, you can see something like 80% of us in this room are better than average drivers. And my students are like 90% even. Where are these worse than average drivers? They're hard to find. But that's an illustration of just overconfidence. And of course, I'm not going to ask you, I could have asked, how many of you think you're a better than average investor? But I'm a little wary about how you're going to raise your hands on that one, because you don't want to say I'm a worse than average investor. That's me, in front of your colleagues here. But anyway, we have these kind of distortions in the market. We have the monograph that I'm talking about here really hints at a lot of these things, but we have actually a follow-up paper that we're working on, which is quoted there at the bottom, the PAPM with heterogeneous preferences and expectations. So that paper, it's very easy to take the PAPM, though, and bring it to a heterogeneous expectations framework, because you already have heterogeneous preferences for all sorts of other things, and now you just have to have heterogeneous estimates of what the values of these companies are. And so it's just like another term. It fits into the whole mathematical structure. It's a simple change in the mathematics to bring in heterogeneous expectations. Whereas in the CAPM, you couldn't possibly, once you bring in heterogeneous expectations of the capital asset pricing model, you've totally thrown out the whole nature of it. It starts looking like the PAPM, in fact. So it's very easy to bring in behavioral finance in both kind of mistakes that people make, or different opinions that come in, or just in terms of we may collectively just like brands, for example. Okay, so now we'll go back to our balance beam, and our balance beam now has still we have valuation. I put in dark there the classical ones, the risk, liquidity, taxation. Those are still there. But in a behavioral framework, we can have all kinds of other things like branding, overconfidence, herding, framing, anchoring, whatever, all those kinds of things that might affect valuation up or down. So they can be popular or unpopular. So anything that is going to be systematically popular or unpopular is going to, if it's If it's popular, it's going to raise the valuations. If it's unpopular, it's going to lower the valuations. And of course, the lower the valuation, the higher the expected return. So they're not going to be, the key is it's not going to be removed by arbitrage here. These are things that are going to aggregate across the demand curves. So now we get to the, we can look across these things. We have the classical finance on one side and the behavioral finance on the other side. And most of the earlier renditions of the classical finance just look at risk, where they just look at the cash flows and expected returns and risk and return. But of course, classical finance also includes taxes, liquidity, trading costs, things like that. Other market frictions can go in there because certainly even in classical finance, we recognize that market frictions are part of the rationality. We certainly know they exist, and we know we don't like taxes, and we know we like liquidity, and we know we like things that have lower trading costs and so forth. So, and we know also, though, the key thing, I guess, the start of all this is we don't like risk. Risk is unpopular. So, the CAPM has the risk part. That's unpopular. We're just adding other extra things that are unpopular there. But then we go to behavioral finance, and there's two kind of types of behavioral finance distortions here. One is the sort of psychological. There's certain things that we like kind of collectively. Like we just like companies that we can recognize. We like things that we're familiar with. You know, we don't like things that we're less familiar with, at least relative to each other. We also make cognitive errors. For example, Kahneman and Tversky, who originally developed behavioral economics, they came up with many different examples of how we just think kind of wrong. Like they could show something like where we like A greater than B, and we like B greater than C, but then we end up liking C better than A. You know, they could show us kind of examples that they even would trick their statistical mathematical colleagues with this kind of stuff. So they would fall into these traps, and they had a lot of fun doing that. But it kind of shows that we do make these kind of mistakes. And will they get into the market prices? That's the point here. Our point is, if a lot of people make the same mistake, it can definitely get into the market, even if there are some arbitrageurs who recognize that it's a mistake. All right, so now we've got popularity, including everything here. We've got the equity risk premium is really just about risk. We've got the small cap premium, which is partly about risk, because small caps are riskier than large caps, but it's also frictional in the sense that it's harder to buy small cap stocks, and they're also less liquid and so forth. We've got the liquidity premium, where things that are less liquid are going to sell at lower prices, and we've got how they're taxed. Those are all kind of frictional things. On the behavioral side, there was a long time attempt, started with, say, Fama and French, where they try to talk about value risk premium as being a risk premium, but it's not really. It turns out that, my measures anyway, the value stocks turn out to be less risky than growth stocks. So it's not necessarily a risk premium, but we don't like those value stocks. I guess that's why they haven't done as well long term as growth stocks. And now we get other kind of explanations, like growth stocks, for example, have great stories behind them, and value stocks are usually, there's something wrong with those companies. And so historically, we've disliked value stocks because they actually weren't very good companies. And we love those growth stocks because they had, if we potentially could extrapolate that growth, they had just wonderful prospects ahead of them. Well, that's Those are really behavioral perspectives. They're not really classical, if that value premium exists. By the way, as you know, all of you know here in this room, that value maybe got too popular in the last several years, and it has been unpopular for a long period of time, but maybe it got too popular, but it's had a pretty bad run over the last period of time. It also, of course, had a bad run in the 90s. I'm not saying it may be getting set to have a good run again now, of course, as it gets unpopular. But something like value could get too popular as well. But historically, value has been unpopular and growth has been popular. And any of these other premiums like brands, and so forth, where we want to buy the brand, or the low beta phenomena, we can give an explanation for the low beta. The explanation is typically given are that you have leverage constraints. So let's say you're an active money manager, and the market mostly goes up, of course. So if you have a high beta portfolio in an up market, and the market goes up in the US about 70% of the time, if you have a high beta portfolio, you tend to beat the market in an up market. So you win most of the time. So an active manager may prefer the high beta portfolios. But if they like them too much, then it turns out that they get overpriced relative, and the low beta actually does better, and that's what we've actually had historically. The low betas have beat the high betas, even though the CAPM said the opposite. But it has to do with how popular low beta is relative to high beta. So, all right, so that's those are the kind of things we now can have explanations for everything here. So we can explain every premium in the market, almost every premium in the market, and every anomaly in the market with this popularity. But I want to go beyond that a little bit here, because these are after the fact explanations, where you found out that value did better, and then you give an explanation for it, or small caps did better or something. So we can easily give explanations after the fact. So I just want to test a couple of things here that you would get out of a popularity model that you would not get out of a traditional pricing model at all. And these are such things as branding, reputation, moats, tail risks, things like that. A lot of these things, I'm just going to show you two examples here. That's more in the monograph here. But I'm going to show you a couple examples of just things where we'll specifically try to look at something that PAPM should catch, but no other model particularly would catch these sort of things. All right, so here's Interbrand essentially ranks the brands every year in the market. And this is from 2014, but they do this every year. And they list a brand value. So in 2014, Apple had the highest brand value, and Google had the second highest brand value, then Coca-Cola and IBM, and so on down the list. And we're just going to now take their whole list of brand values and compare the top quartile with the bottom quartile. And, the general, I guess, simplistic way to look at this is, well, the stocks that have the better brands should do better. But of course, we're the counterintuitive. We're the disruptors here with the PAPM. And we would say that it's actually the unpopular, the lower brand, the brands should do worse, we're saying. So looking at the empirical results, in this case, it's pretty clear. Over the 17 years, there's a pretty big difference. The lower brands outperformed the higher brands. I haven't updated the study to this year yet, but the lower brands had substantially higher return and at about the same level of risk. So this is, I don't know if it's a surprise or not to you, but it's not a surprise in the context of knowing that brands are very popular. We want to buy the familiar. Okay, now here's another method. Let's look at the Morningstar has picked up on this idea of economic moats, and Warren Buffett talks about this too, actually, where you want to buy a company that actually has real staying power here. there's all these different examples of this, that the companies that have a lot of intangible assets, that it's hard for the customers to switch out of it, that they have a scale advantage and cost advantages and so forth. Those are the kind of companies you'd like to buy. And now we'll look at these results. These are a little more mixed. It turns out that the lowest moat did better in returns than the highest moat, but they had higher risk. So I don't have the betas in here. But in any case, at least on the raw return basis, these powerful moat companies actually did not do as well. They were less risky, though. Okay, so now let's go to, I'll try to put all this together. Essentially, popularity, it's such a broad concept that it can't include everything. That's why we got this in one big ball of everything here. At the left-hand side, all the kinds of things that are in classical economics. And then on the right-hand side, my right, or that's your left, your left-hand side. And I can make that transition sometimes. So, okay. But anyway, the green is are the behavioral types of things. So popularity can include anything. It's just our preferences. And so we can conclude here with the PAP. It's a generalization of the capital asset pricing model. We've relaxed the assumptions. The monograph doesn't explicitly talks about heterogeneous expectations, but a follow-up paper does. And it really sets it up with very few changes. And it does hit at it all the way through the monograph. While the monograph has the heterogeneous preferences, but you can also have the heterogeneous opinions. That's not a big leap here at all. It's a simple mathematical addition to the model. And so we can now allow for mispricing too, any kind of preferences, any kind of mispricing, and the preferences certainly don't have to be anything about risk. They may or may not be risk related. They may or may not be rational, or they can be classical or behavioral. So, but essentially it's a simple message that the stocks with less popular characteristics have lower prices and higher expected returns, and that ultimately just doing this intuitively thinking about things, that popularity provides the bridge between classical and behavioral finance. And even though it's the conclusion, I'll put one more slide up here. I might have held this for a question because I'm sure it would come up, but how would you apply this? I'll ask the first question, okay? Not that I don't like your questions. They're wonderful questions, but I'll ask the first question. How would you apply this? Well, actually, we're using linear utility models in our paper and so forth, and in the monograph. So you can certainly do this linearly. All the kinds of things you're already familiar with can be in these models. I remember I showed you the balance beam with all the bundle of all kinds of things there. Anything that affects our preferences can affect the expected returns and the valuations. So in the CAPM, it's just the top line. There's only one thing that's in there, and that's risk. Risk is unpopular. And then you go to the Fama French, say, where size and value, small caps and value are unpopular, and they should have a premium. And then you go to, our paper is actually based on NET, New Equilibrium Theory, which is a paper I published in the Financial Analyst Journal way back in 1984, which showed a lot of this stuff in the classical framework, which we're actually building off of here. But now that includes the liquidity, the things, the risk anomalies and so forth that you would get. And then popularity can include a lot of other things like ESG, brands, momentum, whatever. It can include a lot of other things. Anything that is popular is going to increase the valuation, and anything that's unpopular is going to lower the valuation. So now I have just the right amount of time for questions, right, Ted?
Wow. You absolutely nailed it, Roger. Looking at a timer right now. Forgive the pun, but the most popular question had to do with ESG. So would you continue? Do you think that ESG-related investments, the fad of the moment, are overvalued today? And if not, will their popularity lead to overvaluation in the future?
Yeah, ESG is in that chart here. I guess I have it there at the end. So ESG it can be popular. One of the questions we have to ask is ESG affecting the supply or mostly on the demand side? It's probably mostly on the demand side, but it might affect the supply side. This is a demand model. I guess there's good news and bad news about ESG, because I care about the environment just like most of the rest of you. The good news is, to the extent that ESG gets very popular, we're going to lower the prices of the kind of companies that don't have good ESG policies. We're going to lower their prices, but that means, of course, if we haven't changed their cash flow patterns, that on the other hand, we're going to raise their expected returns. So it's not free for us to follow this pattern. But we might also be affecting the supply. On the other hand, I will also say that the companies that have the worst policies it's easier for them to improve than the companies that have the best policies. And it's the change that actually gives us the change in demand. So what you really want to buy in general is companies that are not popular, but getting more popular. That's the best possible thing, actually change in popularity. If they're not popular, they have a better long-term, essentially, discount rate. I don't have a blackboard here, but if you think of a simple perpetuity model where there's a value, the valuation is equal to the cash flow divided by the discount rate, the more, if those cash flows are fixed, the more you affect that valuation and bring it down, the more you raise that discount rate. And the more popular ESG gets, the more we bring the valuation of those companies down, which I guess they deserve it. But the more, if we don't change their cash flow patterns, the higher the expected return of those people who do buy those companies.
Number of questions about arbitrage. If arbitrageurs are limited in their positions by risk aversion and cannot arbitrage the differences between popular and unpopular stocks away, why should popular stocks have a lower return than unpopular stocks? In other words, why should popular brands disappear within a reasonable time period?
Why should the popular brands and we don't want, if you are a company that has the popular brand, you want to keep your popular brand, of course. The more popular your brand is, the more valuable your company is, the higher the valuation. The problem is, it's great to have companies are trying to make their valuation as high as possible. That's their job. But if they don't change the cash flows, if they just make their valuation higher without changing the cash flows, then they're going to have lower expected returns for their shareholders. So companies are really trying to do two things. They're trying to improve their cash flows in the future, but they're also trying to always improve their reputation and so forth, all of which will raise their valuations. But on the other side of the coin, it's going to lower the expected returns. We are going to essentially, to get us to buy the unpopular stocks, you have to offer us higher expected returns. Those unpopular stocks are going to have low values and high expected returns. I want to say one follow-up, because you mentioned the arbitrage, though. And that's really a key point, because, and the question was a sophisticated question, because it's the fact that the arbitrageurs have to diversify themselves, that they're risk averse. That's what, often in the literature, they have infinite arbitrage, But in fact, none of us can do infinite arbitrage because we're risk averse ourselves. The arbitrageurs, even if we have an information advantage and we aren't restricted by these preferences, we are always risk averse. That's the one thing that doesn't go away. And that's why it's so important to build on the capital asset pricing model here, because that's all based on the market with sufficient frontiers and so forth, where everything is risk averse.
Almost the entire free float of Lyft is short. Doesn't that show that popularity can be arbitraged away?
What was the question?
Almost the entire free float of Lyft, the new IPO.
Oh, Lyft. Okay.
Doesn't that indicate it can be arbitraged away?
I don't know whether Lyft is overpriced or underpriced, if that's what this question is trying to get me to say. I'm not saying that in order to have a distorted price, we need an imbalance in some way here. We need, and it's actually IPO. I have studied IPOs. Actually, my original dissertation was on IPOs, and IPOs tend, for technical reasons, they tend to be underpriced on the offering, and they pop the first day, although Lyft didn't, and neither did Uber. But they tend to be underpriced on the offering, and then they tend to drift downward because there's a lot of excitement at the time of the offering, and then they sort of lose some of their popularity over time. And certainly my work and one of my co-authors, Jay Ritter's work on IPOs, has shown that buying IPOs after the offering at their hottest time actually tends to have poor results. So it's quite possible that Lyft and Uber might not have great performance in the next couple of years from that perspective, because this is the time when everybody's really excited about them.
Your talk of popularity and lack of popularity kind of sounds like growth and value. What do you think?
Well, growth and value are a good example of this. And, but I think that's good that you said that, or whoever asked that question, because traditionally we've been talking about growth and value as a value risk premium. And value is not higher risk than growth, at least by measure of betas or standard deviations or any type of thing. So yes, I do think that popularity is the proper way to look at growth and value. And so is behavioral finance, the proper way to look at. I don't view that as classical, even though it came from Fama and French. And actually it didn't literally, because value came from Basu really back in the early 80s and 70s, and a small, so the concept actually came much earlier, but it got tied into the idea of value risk premiums, and I don't believe that growth and value is related to risk premiums at all. I think it's related to differences in popularity. So tying them together is fine. I think it's really all behavioral, and popularity is a good way to describe it, but popularity extends beyond that, though, because although popularity can explain value versus growth, it also explains really all the other things that we have to look at here. So obviously you can see I'm pretty enthused about using PAPM models, because I think they can be practical in the sense that you can still use the kind of factor models and so forth you're familiar with. But now the only kind of factors that really should show up are where there's some sort of systematic bias in favor of some really systematically, well, the classical things are going to stay there because we're going to always be risk averse. We're always going to want more liquidity. And some of the behavioral things can change over time. They can be more changeable. Even the classical things can dynamically change because the price of risk or the price of liquidity can change over time. But those, in order to get in our factor models here, they really have to be unpopular, any of the premiums here. They're not risk premiums, some of them are, but they're really unpopularity premiums in this context, which is much more intuitive because we don't have to push things into a risk framework where they don't really fit.
Zebra Capital's superior returns leads one listener to ask, what's the best indicator of a stock's
Well, there are
popularity?
a lot of indicators of, we can, clearly I've given you, and the monograph doesn't tell you exactly how to implement this. It has to do with what to look for, really. And one of the things we look at is how much trading activity and so forth is in these stocks, because it's when there's a lot of trading activity, there's often a lot of excitement about stocks. So that's certainly one of the things we look for. In general, though, it's a changing set. It isn't necessarily a fixed set because, well, even value versus growth, it's not endemically clear. It's not always going to be the case that value is less popular than growth. I guess that when we popularized it so much, it actually could become too popular. So any of these things can change over time. It's not a recipe, what we're doing here. It's really a theory. It's not a recipe to literally what to do. It's a recipe of how to do. It's sort of like my uncle once said to me, well, what is college? What do you learn in college? Because none of my family went to college, you know. And I fumbled around, and then he talked to somebody, and then he came back the next week, and he said, well, what college does is it teach you how to think. I liked his answer. So yes, and that's what we're trying to really do here. We're teaching you how to think about things here. It's not literally a recipe, because you can now put in your own ingredients here, how to do this, but it's telling you what really matters, I guess. And the mathematics it's actually simple. It's just intuitive. We don't have to, you may not, we get so, say like the capital asset pricing model, we get so ritualized in how we do it and so forth, we don't even think about where it came from, you know. But here in this PAPM, you ultimately, you want to know where it came from. If we have a systematic bias, a systematic excess in demand in anything, that's going to mean that you're going to lead to higher prices and lower expected returns.
How do you measure brand value for companies that aren't covered in Intrabrand?
I'm not going to really answer that question because we just took the brands that they were given there. I mean, I could come up with some ways of measuring brands, I'm sure. However, so could you, I guess. So I'm not the expert on brands. I'm just taking somebody else's cut on brands, but it does seem like brands is one of the key considerations of how you would measure. It's something that's obviously popular, I guess, and other models don't really pick it up in the same way. So this is something that's why we did this and a few other tests like that. We're trying to pick things that were we would not debatably, everybody would know that they would be more popular, and other models don't pick it up. But I don't know how to. I'm not going to tell you how to. I like to enhance my own brand. I'm hoping that by telling you that that anything that is popular has lower expected returns, I'm trying to be popular as I can here. But I guess that means well, you don't have to buy stock from myself.
Roger, is the PAPM disprovable?
Is it disprovable? Yes, it's a concept, and it has equations, and it's pretty flexible because it can include all the kind of anomalies we already talked about that you already are familiar with. But it's disprovable. That's why we picked something like brands, because or moats, trying to pick things that would be in this model but not in other models. And so in that sense, it's disprovable. I don't really think it's disprovable on a generally conceptual level, because it's just a debate about what's popular and what's not popular. It's almost definitional, because once you say you're defining popularity by demand or excess demand for something, then clearly it's going to affect the prices. Now, you can have periods, though, of course, where something is overly popular, like in a bubble, but keeps on getting more popular. So you can certainly have long periods of time when these things will not pay off for you. They're not in any way guaranteed. It's really the denominator in the valuation formula. That denominator is in valuation, it's the discount rate. It's also in corporate finance, it's the cost of capital, and for us investors, it's the expected return. They're all tied in together. And the expected return is I guess it isn't, in order to be a good theory, it has to be disprovable. So you try to pick the things that you clearly fall into it, but inherently, it's when you have a higher demand for something, you're going to have a higher price and expected return. So it just shows up as an equation, I guess. So it can't literally be disproved, I guess.
Thank you. This question I have to read verbatim. You'll understand why in a second. And forgive me, because the screen is popping up with the questions as I'm trying to read it. Kahneman's theory relies on the value function and weight function. Both change the shape of the returns distribution. It's fat-tailed and skewed. Moreover, the mentioned phenomena such as sentiment, herding, etc., lead empirically to bubbles and crashes, that is, fat tails. The presented model stays in the normal domain, that is, it does not include probability of extremes. How do you bridge the two?
Well, let me say, tail risk is part of something that we've studied directly. I've written papers on that topic. The companies that have had some something bad happen to them in the past, you tend to remember them, and they tend to be lower valued. And I've studied it, and they tend to have higher returns. And interestingly enough, past tail risk is not a very good predictor of future tail risk. Something that happened really bad in the past to a company doesn't necessarily indicate it's more likely to happen in the future. So it means that you can actually buy companies that have had something bad. They're remembered. It's always damaged their reputation in some way. If it doesn't affect to the extent though that it doesn't affect their cash flows, it means lower valuations and higher expected returns. Now, I'm not sure I answered every aspect of that question, but I know parts of it, I guess.
Thank you. I'm also going to take the prerogative as the moderator of not asking you a question about Boeing and tail risk. Instead, I'm just going to call the end of this session, and will you thank me and join me in thanking Roger for his speech.
Thank you.
Copyright 2019, all rights reserved. This program is designed to give accurate and authoritative information in regards to the subject matter covered. It is distributed with the understanding that CFA Institute is not engaged in rendering legal, accounting, tax, investment, or other expert advice. If legal advice or other expert assistance is required, the services of a competent professional should be sought.